Welcome back to Small Caps. My name's Kerry Stevenson, and it's our fortnightly update with the wonderful Tony Locantro from Alto Capital. Look at him. He's wearing his branded shirt. Is that a horse or a bull? It's a bull,
It's a
isn't
bull.
it?
It's a bull.
A bull. We're not going to talk about the horse race because actually there was some sad stuff yesterday. So needless to say, are you feeling a little bit dusty today, or are you doing all right, Mr. Locantro?
I always make it a day of the Melbourne Cup. So we went to the Crown Ballroom and drank bubbles on tap and watched the horse race. And I thought that jockey John McNeil had showed some real balls in what he did leading all the way, pretty much. So that he took the race away from everyone else. And it was sad to see Anthony Van Dyke pass away in that race because I had a little bit of money on him. But anyway, it's racing, and I liken the Melbourne Cup as to speculation, all about risk reward, reading the form, conditions, wet track, dry track, and all that. And I apply the same methodology to speculation.
Well, I guess that's as we've said before, high risk, high reward, kind of like the Melbourne Cup. However, in the markets, you can also do your research. Now, I've said it before, I'll say it again. A lot of people at the moment are just sort of diving in on the basis of, I saw a post on social media. Not really a great way to invest your money. So what I wanted to talk about today, Tony, is, I guess the life cycle of exploration companies and, at what stage are good times to come into the market, and at what stage is it sort of take the profit and move on? And when, sometimes people stay in a little bit too long and lose a lot of their money. So what I want to talk about today really is, what should people be looking for? Whoops, sorry, I've completely lost you there for a minute, Tony. Let's get back to you. Where are you? You've gone. There you are.
Really?
Technology, but I'm back. So I just want to talk about the life cycle of when people should get in and when should they cut their losses or when should they stay in. And, you've been in this market for over 20 years. You understand, don't stick in just because you might be losing, because you could lose everything. What are your thoughts to that? And what would you say to people out there listening to you who might be new to the market?
Well, I go back. My partner jokes that I always go back to the time Kurt Cobain died. And that's the time I was right into the market. So I started my research journey since then. And I used to buy a lot of rubbish companies. I'd buy $500 worth of complete dog excrement. And I kept doing this for quite some time. And I was reliant on newspapers. So I think people in their early days are going to go, if they go straight onto social media, if they rely on tips, are going to buy a lot of crap. And what I've noticed now is some people from this program have come to me that are exhibiting the same signs of me back in 93, 94. And what I'm saying is now, if I turn you around now, I can save you 4 to 5 years of pain. And my struggle, honestly, is getting my clients to sell. I'm going to grow my hair back so I can pull it out again, Kerry, because it's like bugger me. I deliver you 1,000% return, and I can't even get a sell note from you. Like, what do I have to do? If you've made 10 times your money, please sell. Even if it goes up another 10, 20%, you got to look at it this way. You put 10 grand on a stock, goes to $100,000. Like, get that in a bank.
Never.
You go, oh shit. I mean, 10 to 100. And you've got to ask yourself, would you put $100,000 on this stock at that price? Most times the answer is no, because these small cap stocks, unless you're going to become a producer or a biotech that has a breakthrough, they're cyclical. And, you've got to work out what type of stock it is. You can't be a 1,000-meter sprinter in the 3,200-meter horse race. It's horses for courses. And I think what my clients are struggling to do is differentiate between something they should sell that's not going to turn into a real company as opposed to holding long term. So to me, that's my struggle. And I think what clients do is it's very hard for them to change their behavior. And I try and provide some client etiquette as to what to do when a stock's going nuts. I mean, we recently had Dampier Gold, for example. I raised the money at 2.2. They came up with some great results. Then suddenly, not long after, they're trading at 12. And I can see the pip traders in there. And no matter how good that company is, we needed to take some money off the table. And for a lot of people, they couldn't take 5 to 6 times the money, because what if it goes higher? But what I'm trying to tell people is that when I see good results, I see the pip traders moving in, and they need to be fed stock. So look, this is such a tough game. No matter how much research people can do, it's going to take a lot of time, because I've been doing it 28 years and I'm intense with it. So I don't know what hope someone coming into the market has that's going to be reliant on tips, and heaven help them if they now go into exotics. So it's a really tough area.
What do you mean by exotics, Tony?
Like warrants, options, contracts for dickheads, all of that stuff.
No straight buy seller stock. It's all as you say, the exotic stuff. I don't get into. I buy a company because I like it and I trust the management. I mean, do you take into account management when you're looking at buying a stock?
I take everything into account, and that stems from what's being said on social media. I look at the top 20 shareholder list. You learn so much for that. I think at the AGM, I know a lot of them this year are going to be virtual, but the chairman's address is the biggest free swing a company can have at selling their story. Yeah. And so I always recommend reading the chairman's address, look at how much stock management have. It's all encompassing, and work out who's there to build a real company and maybe sell it to someone else, or is there for the lifestyle, the conferences, trips, lunches, all of that stuff.
Lifestyle companies are not for us. Sometimes, and I've asked this, I think, before with you, but it'd be useful to have a look at it. You've got a small cap company, and let's just take the mining sector as a starting point. They're an explorer. They're going to be doing. My mother would kill me. Going to be doing some drilling. You're not sure what they've got, but all your research says good management, good asset. You're going to pop some money in there. They get some good drilling results. The stock price goes on a bit of a run. Would your advice then be to say take some profit?
Absolutely, because I know the volume moving into these stocks, and you see it there in the pre-open. However, I must disclose that some of the biggest discoveries that have been made, like Nova, DeGrussa, even Prominent Hill, you actually had a day or two to buy that stock that had hardly moved because the dumb money was getting out, and they were massive discoveries that turned into multiple upside. So you need to work out, well, is this a new mineral province, something that's going to become a mine, or are they just directors' holes over areas that have been drilled like Swiss cheese? So that differentiation does take time. So there's a lot of factors involved, and people should realise that I think 1 in 1,000 prospects becomes a mine.
Yeah, absolutely. And I've heard that many times before. So, if people are saying, well, this one's going to go into a mine, not necessarily. So why do people bother investing if it's not going to get in, if it's only 1 in 1,000 go into a mine?
Because you have the pyramid effect. You have small stocks that become grossly overvalued because people tip them to other people. You have the social media push. So you can still make a lot of money out of companies that will never produce anything apart from brokerage and heartache. So, there is a life cycle of a junior explorer. And on the Australian market, just like the Canadian market, we have companies that will transform 5 times into what's hot, and they become a fad. Like we'll see lithium projects picked up, then a gold project picked up that's old, regurgitated with some high-grade hits. So you see these companies constantly jumping on the bandwagon. And I guess that's part of the Australian speculative spirit to do that, whilst I tend to stick with the high-quality explorers that eventually will crack it.
But you don't just look at resources. You also you've got a bit of a fave with the biotechs as well, which is that more is that trickier because it's science and it's there's a long a period of time where they're doing all of this research and going through these testings and all the rest of it. I mean, do you need to have a bit of a science background in the biotech sector to be able to understand it?
Well, I try to educate myself, but I am of the belief that if you know too much, you're not going to buy anything. So what I focus on is finding people I can trust. Yeah. And that's the main thing. I deal with some really good people in the biotech sector. They don't spin me lies. They're not there for the lifestyle. They're there to improve science and make people money, which is what speculation is all about. So I've been fortunate enough to get in with some of the right people in the sector. And I look at a stock like Exopharm, which I floated, that now has ex-CSL staff on board. And I'm thinking, well, wait a sec, what are they trying to build here? And to me, that's a longer term proposition. But if ex-CSL people are jumping onto this small biotech in a field that's quite new, then it's got to have potential. But I really like management. So that's a company I'll stick with. Like people in that sector have stuck with companies like Nanosonics, Polynovo, Opthia as well from an early stage. So I just think that that's an area where some big money can be made as well. So what I'm doing with my holdings in Exopharm is the coffee can approach, sell a bit over 5 years and give that company a chance to grow, because sometimes your greatest trading tool is actually your backside, doing nothing.
Tony, we talk about, putting some money into a company, you've made some profits, take the profits off the table. Do you ever stay in a company for the long haul? In other words, like the Warren Buffett approach. Warren Buffett always says, buy undervalued companies that are good and stick with them for the long term, because the dividends over time will pay you back and some.
I think you can do that on companies like Coca-Cola or Apple or Amazon, which has gone absolutely ballistic. You can do that on those old favourite companies. But in Australia, we're more cyclical. If you turn on your hindsight 101 trading system, you would have seen that you should have kept buying CSL.
Yeah.
Back in the days where I actually remember at the stock exchange, the prospectuses were there no one wanted the stock, and they actually struggled to get that IPO away. But that's a rare story. You might have looked at something like Commonwealth Bank, would have been an ideal one. But if you have a look at something like Westpac, which has actually halved over the last 5 years, that approach always doesn't work. So I think what Buffett has done has bought solid businesses, held it, reinvested, and made that famous 22% per annum. But in what I do, I'm aiming to beat that, obviously with higher risk. So this year we're looking at a baseline, probably up to about 95% return for the year. But next year it could be down 20.
Yeah.
So it's got to, yeah. But that's the risk reward. So, but no, I'm certainly not going to be a Buffett, but I would advise viewers to buy the book 100 Baggers. I think that book's well worth reading.
It's called 100 Baggers.
Yep.
Do you remember the author?
Christopher Mayer. 100 to 1. Yeah, stocks that increase 100 times.
100 Baggers by Christopher Mayer.
Yeah, 100. I'll just get the exact title for you.
We love a good book.
Yeah, I just think that book will give. It'll just show how quickly some stocks can increase 100 times. And there's actually an interesting list in there as well. So yeah, well worth doing, well worth reading. And even a company like Monster Beverages took 7.5 years to go 100 times. So that's energy drink company. So it can happen. But I think in the case of Australian stocks, it tends to need a fad or a certain amount of BS to get to that level.
Do you think at the moment the market now? I'm talking to you on the evening after the US election. We don't know who is in. I know you couldn't give a toss about politics, and quite frankly, doesn't matter if Trump or Biden gets in. The money printing will continue. Does that mean that the market at the moment is a little bit toppy, or do you see it stronger for longer?
I think stronger for longer and lower for longer are dangerous phrases. I think, I think markets are priced for absolute perfection when we're going into really tough economic times. We've still got a lot of job losses to come. You know, the stimulus is going to wear off. And I know we just had an interest rate cut here down to what, 0.1. I mean, that's just ridiculous when people need to realise that the long-term RBA cash rate is 6.5%. That's a long-term average. And you add a couple of percent onto that. So the average long-term mortgage is 9.41. Now you can get a loan below 2. So it's certainly abnormal times, and where you have markets that are priced for perfection based on liquidity. Admittedly, this work from home culture, people ordering online, has helped the likes of Amazon and other tech stocks like that in the US. But I just think Westpac's earnings decline, I think the warning signal for Australia, and the fact that markets will readjust, and this election euphoria in the States, if it goes either way, it'll wear off. And I think markets can sell off on good news, as our market and world markets have risen on bad news.
Well, I'm going to ask you a question which is totally and utterly selfish. You mentioned Westpac. I got some Westpac shares, and yes, they have halved. I know the pain is there. Would you just say, listen, just keep them for, the next 20 years and you might get back to where you were? Or would you say it's like catching a falling knife, get out now?
Well, you've got to work out, there's a saying, there's been no greater wealth destruction than in the hunt for yield. And I think they're going to go lower. And I think at some point there'll be a chance to buy it cheaper. So, I mean, yeah, they've come down from 35. I think they're now around 17. Did fall as low as $13.47 during the COVID crunch. But look, I still believe our banking sector is still a sell. However, you are going to see this hunt for yield where people that can't get any interest in the bank are going to look for the bank stocks. But these dividends, I think, are going to be slashed even further. So in the end, this might actually start to help the likes of Telstra as the money flow goes into that, or even something like Tabcorp or Star Group. So I just think the hunt for yields is going to switch out of the banks, which it has been doing pretty much for the last 5 years.
Yeah, it's interesting, isn't it? When you've got interest rates just going to so low, if not zero, possibly negative, I don't see how the banks can continue to pay a dividend if they're not getting the sort of returns they were for themselves before.
Exactly. And I still think we're in this cloud of stimulus. I think, obviously consumer confidence, when people are handed money, is higher. They're saying that people aren't spending money on holidays, but they're going out and buying crap online they don't need to impress people they don't like. It's a bit of a worry, because I think eventually it's all going to come crashing down.
Well, Tony, whenever I talk to you, I always say, let's talk about a couple of favourite stocks of yours. Did you want to go over a couple of those for the week? And by the way, ladies and gentlemen, let us to just remind you again, this is not financial advice. This is just education, entertainment. Do your own research, I must say, because I am certainly not a financial planner. We are doing this, having a discussion, but please do your own research. Tony.
Yeah, well, as I mentioned, Dampier Gold had that huge run for us. The stock fell back. It's back to around 6 cents. I really like where this company's going to head next year. I think you've got momentum. You've got all the signs there of potentially a major gold discovery on multiple projects. So and their market cap's still quite, it's not demanding. So that's certainly one that I've gone back in and are accumulating now for clients. I've also been accumulating Hammer Metals, which is a similar style of gold stock, good management, growth prospects as well. I really like that one. One of my old favourites, Red Metal, are drilling a copper project at the moment. Their last couple of drilling programs haven't given much, but it's often the projects that you don't expect to come in that could. So they're drilling. They should have results out in a couple of weeks. Staveley came up with some really good gold numbers. That was great. That got to about 86 cents. They're currently back to 77, but they are drilling those 1.5 kilometre deep holes in the hunt for the porphyry. And I still think the stock's undervalued on the shallow copper. So I think around 77, that's one also worth accumulating. Mako Gold MKG, 10.5 cents. That's an African gold play, which I really like. They've decided to change their drilling direction. Could be some really decent results out of that company. And I think that's a longer term growth story. So we're still accumulating there for clients. And probably one of the loosest punts, pardon the pun, that I have at the moment is a company called Metal Bank, where they announced that all 5 data sets have pointed to a large IRGS system in North Queensland, and they're actually drilling that at the moment. And if that's mineralized, watch out. Absolutely watch out. That could be anything. But again, it's exploration, it's geology, it's Marbo, it's the vibe, it's all of that, Kerry.
And you know what? It can go from hero to zero, ladies and gentlemen. So as we said, do your own research and make sure you understand what's going on before you put any of your hard-earned money into this, what I term, and I'm sure, Tony, you would agree with me, it's a bit of a crazy market right now.
Absolutely, sure is.
As always, great to chat with you, Tony. Any final comments for our listeners out there?
Well, I think stay tough, stay strong, enjoy the freak show out of the US. So I'm just hoping that it doesn't get towards more rioting and giving people an excuse to smash the window of somewhere in Beverly Hills and steal handbags. I hope we don't get to that point again. Sadly,
Tony, I think that's exactly where we're going, because it wouldn't matter whether it was Biden or Trump. I think there is so much divide and so much anger. You're not going to be able to stop it, whoever gets into the White House. It's very tough times for the US, and I think the world right now. Let's hope we come out of it the other side very soon. Thanks for joining us today on Small Caps.
Absolute pleasure, Kerry.